All right, so one of the reasons why I absolutely love reading investing books is because we get to learn from all of the experiences that the great investors over the last century have been through, because their experiences are well documented. They're in books like 100 to 1 in the stock market, Richer, Wiser, Happier, Beating the Street by Peter Lynch. We get to learn that everything that we are going through right now as modern day investors, they've been through it, and they share how they managed to succeed. All right. So this is a chapter from 100 to 1 in the stock market by Thomas W. Phelps. Fantastic book. I've shared it with you, but it's called Foresight versus Tenacity. All right. I'm going to share this with you, but find this chapter answers a popular question that's being asked right now by retail investors. All right. This is from Dr. Parikh Patel. He's a really, really funny guy, but he asked this question, right? How is it that when the stock market is up, all my stocks are down? And when the stock market is down, all my stocks are also down? I think that's a phenomenal question. I think we all have that question, particularly if you are invested in small to mid-cap stocks. On Monday, I didn't want to call it and say maybe the rotation back into small and mid-cap stocks was going on. I didn't want to jump the gun, and I'm glad I didn't, because look at today's relative performance, right? Your small and mid-cap stocks are getting crushed yet again. All right. So we had that 1 week where we saw some light at the end of the tunnel with small and mid-cap stocks, but we're back. Guys, we're back. Wall Street are back to playing their games. Heavily shorted the small and mid-cap stocks once again, and the best performers were the mega caps, and it's pretty much been like that since mid-Feb. So this is the age-old question, and I think if you are heavily invested in small to mid-cap stocks, you probably have this question as well. Now, with that said, let's bring up this chapter. So this was when the company Automatic Data Processing actually listed. All right, so we're going back to 1961. Okay, and it says here was a stock which declined 70% in market value in its first 13 months of recorded trading. And that's it right here. So let's say you bought at the IPO or at the offering, and it went down pretty much for the whole year. It went down for the rest of the year. For the whole of 1961, it collapsed, right? And then turn of the new year, 1962, what happens? You see this little bit of a dead cat bounce, and then boom, it drops again, right? So it drops 70%, right? Only to turn around and make $100 bills out of $1 investments between 1965 and 1971. And you can see, look at the rally there. But how many people would have sold on this decline here within those first 15 months of it just constantly declining, and then you see a dead cat bounce only for it to drop again? I mean, it would have taken some tenacity, and that's why the chapter is called Foresight versus Tenacity. And it closes off by saying it will be hard to find a better example of the hazards in relying on price movements alone as a guide to investment decision making. So if you were stock price watching and you weren't looking at the fundamentals and the financials of the company at the time, it would have been very, very easy for you to have sold, because it pretty much broke all support levels. I can imagine if you drew a Fibonacci retracement tool here, all the support levels would have been smashed and you would have probably sold out. But you needed to have that tenacity and that focus. And if you were happy with the performance of the business, also average down, to then be in a position to be rewarded with a 100 to 1 in this investment within 5-6 years. Incredible. And if you take a look at the company right now, because they are actually still trading, so they are still currently trading on the Nasdaq. The ticker symbol is ADP. If you got in 1961 and held up till now, 2021, I mean, you would be stinking rich. But let's say, for example, maybe you heard about the company in 2001, and let's say you invested at the peak in 2001. If you invested in 2001 and held for the next decade, the next 10 years, you would still be down 19% on your money. And for you to continue holding on to a stock like this for 10 years and still be down 19%, because don't forget, within that 10-year period, you would have massively underperformed the S&P 500, the Dow. This would have been a terrible investment. But if you held on, then the stock rallied in 2011 up to 2021, and you would be up 277%. Or let's say you got in 2011 and you held to now, you would be up over 300%. So from 2001 to 2011 was a miserable 10 years, but then the following 10 years preceding that, from 2011 to 2021, you'd be up 306% on your money. And this is the game, guys. This is the game. This is just how investing is, all right? Stocks don't only go up. I know last year was an incredible year for most of us, but last year was an anomaly. This is real investing, all right? It takes time, it takes patience, it takes tenacity, and it also takes some foresight. So with that in mind, the reason why I'm sharing this is because I'm now looking at the gaming industry. I haven't got any exposure into the gaming sector, which is predicted to grow exponentially within the next 4 to 5 years. So if you take a look at the statistics here, it's estimated that the global gaming market will amount to $268.8 billion annually in 2025, which is up from $178 billion in 2021. So North America is set to remain the top grossing gaming market worldwide, despite strong growth in the Asian region. And it was referenced that in-game purchases are estimated to account for more than $70 million worldwide in 2025. Now, some of the contenders that I'm looking at are companies like Skills. Okay, so Skills has been battered, all right? Looking at the bigger picture, you can see that this stock is pretty much slashed in half. You know, it had highs back in February of $46.30, but it's since absolutely crashed. And right now, I think the evaluations are getting quite enticing. I'm looking at the recent Fibonacci retracement levels, and as you can see, it's pretty much broken all recent support levels. And it right now seems like it's on its way down to the 100% level at $12.76. I'm still doing some due diligence on this company, but I haven't made a decision yet because there are some other contenders. I know HUYA. HUYA is another stock. When you look at it, it's pretty much tanked from its highs of $36.33. Again, it's slashed in half since mid-February, and it's now trading at $13.80. So again, HUYA is kind of starting to look attractive. Like we read in the statistics, the Asian market is also expected to do well. Not as well as the North American market, but it's still expected to do really well. And as a result, I'm looking at HUYA as a potential investment to get my exposure into the gaming industry. I'm also looking at CORSAIR. CORSAIR is quite funny because I actually swing traded CORSAIR. So I initially had a position in CORSAIR at $30, and I sold CORSAIR recently back in June. So I sold CORSAIR on this run up here on the 14th of June. I sold it at roughly around $40. You know, myself and my Discord, we swing traded this and we made some decent money on CORSAIR. But now it's pulling back again. I'm looking at the valuations. It is looking quite enticing. However, I am going to wait for this. Okay, I want to see their earnings because I believe with the likes of CORSAIR Gaming, I think their results are going to be skewed. Because if you think back to 2020, pretty much everyone was in lockdown. You couldn't really go anywhere. So companies like CORSAIR Gaming benefited from lockdown. And now since everything's opening up, people are getting vaccinated, people are now going back to work, people are traveling again. There's going to be less demand for gaming in comparison to last year. And I think their earnings are not going to be that impressive if you are comparing year for year, if you're comparing it from a year over year perspective. So I do think I'm going to wait for CORSAIR to release earnings and, you know, let all of the fear and FUD come into the stock and potentially drive the price even lower. And then maybe in the low 20s, maybe in the high teens. So I'll be looking for CORSAIR to break $22.17. That could be quite interesting because the market cap at that point will also be ridiculous. But I think we could get there. I think potentially CORSAIR could get there and it might get interesting. So CORSAIR is at the top of my list in terms of being exposed into the gaming industry. But I am looking at HUYA and I am also entertaining the likes of Skills, all right? So that's to give you a heads up on what I'm currently looking at. But remember, the takeaway is if you want to be a successful long-term investor, you need to have the tenacity. And I also believe you need to have foresight to be able to hold and understand that a decline in stocks is not a surprising event. It's a reoccurring event, as Peter Lynch says. And don't be one of those investors that sold out in 1961 only to see the stock absolutely rally for the next 5 or 6 years. Thank you so much for watching. I hope you gained a ton of value from this video. Please make sure you smash the like button if you did. Also, if you're new to this channel, make sure you hit that subscribe button and the notification bell to stay up to date with all of my latest videos. With that said, I appreciate your time. Thank you so much for watching and I'll catch you in the next one. Peace.